Good morning, ladies and gentlemen. Welcome to IGE Webinar today. Today, I'm very pleased to have a distinguished speaker, Dr. Sinai, who is joining us live from his vacation home in Florida. Dr. Sinai is one of the world's most respected and renowned experts on economic forecasting. I trust that his insightful perspectives will help us better understand the outlook for the US and global economies, as well as financial markets and investment trends. Yeah. I would like to emphasize that he will deliver his message with a special attention given to the latest stock market turbulence in view of the changing US Fed policy stance on interest rates. As our audience know, we had some important messages gathered overnight at the outcome of the Fed FOMC meeting. He will also, to the extent time permits, he will also touch upon post-pandemic macroeconomic frameworks and geopolitical issues as they are critical for the future of the global economy and international order. Brief introduction of our speaker. Dr. Sinai is a chief economist, strategist, and president at Decision Economics Incorporated. He had served as chief economist and managing director at Lehman Brothers, senior vice president and chief financial economist at Data Resources Incorporated. He had been selected as top forecaster from the Wall Street Journal and USA Today surveys in the past. He is a graduate of the University of Michigan and holds PhD from Northwestern University. Without further ado, let's welcome Dr. Sinai, who will speak for about 30 minutes or so, followed by our Q&As until 10 a.m. in Seoul time as scheduled. Alan, you're on.
Thank you very much. I regret not being there. It's the way of the world these days, but I'm delighted to be with you and the attendees at this webinar this evening here in the United States and in the morning there in Seoul. Today, early in 2022, after a turbulent year of challenges and risks of COVID-19 and surprisingly strong recoveries in the US and world, but we want to take a look ahead to the year and perhaps next year. The most likely prospect for the US and global economies, some monumental shifts in policy, huge shifts in monetary and fiscal policy in the United States and various parts of the global economy. And what that all might mean in the context of a business cycle, what that might mean for business and financial markets, really a sea change in the business cycle and in policies underlying the economies of the US and world for the next few years, not seen in decades. Necessary to note, in the US, a shifting away, underscored by today's monetary policy statement yesterday, Wednesday, by Chair Powell, a shift away from ultra easy monetary policy that has been so long in place since 2012, actually, in the United States. Tighter stance and a focus and emphasis on the federal government in the United States, historically unprecedented fiscal stimulus, beyond that of the 1980s Reaganomics, the 1960s Great Society, beyond that of World War II, in the go-go years of 2003 to 2005 of the Bush-Cheney administration. In the United States, I call it a new deal in a new economy, a technologically centric economy, and ask the question, can the federal government and its emphasis on fiscal policy as it replaces monetary policy in trying to drive the US economy, can it work? Can Washington work? The bottom line of what has changed and emerged and lies ahead is the forecast for the United States, what we call a boomy expansion. It's more than an expansion, it's a boomy one. 75% odds. And for the world economy, we cover 47 countries. It's about 93% of global output. An expansion, a good expansion, not as boomy as the one in the United States. Boomy growth, high price inflation, a tight and tightening labor market, and very strong profits. An economy not seen this way for decades. A radically different picture from the US economy of the last 20 years. It's going to take some getting used to. It's so different. For the US, GDP growth down 2.3% in 2020. That was the year of the COVID-induced collapse. This past year, we'll get later in the United States on Thursday, we will get the final 2021 result. We think for the year, 5.8%. It's a shift from a 2.3% downturn. That's a big downturn for United States history, to almost 6% growth, 8 percentage point shift in direction. For this year, we are forecasting 4.5% real GDP growth. 2023, over 3% and 2.5% in 2024. These are years of above trend growth, well above trend growth. And with the strong economy, we are expecting, have had, and should expect demand pull inflation of size. This past year, 2021, the data will be out this Friday, 5.6% inflation, up from 1.2% in 2020, 5.6% inflation. This year, 2022, about 4.5%. About 3.5% next year, and still in the threes in 2024. High inflation, not accelerating, though that is a risk, and we worry about that because of what it would cause the Federal Reserve to have to do. High inflation, not seen in decades in the United States, indeed not seen since the 1980s. A sea change in the inflation backdrop. Along with that strong economy and the rising inflation goes a fully employed economy by the end of this year. The unemployment rate, 4.2% average fourth quarter passed in 2021. We are currently at 3.9. By the end of this year, we think we'll be at 3%. That's well below what the Federal Reserve is forecasting. That's full employment, and between 3 and 3.5% in 2023 and 24. And then finally, earnings, profits measured by the S&P 500 operating earnings, up a very strong 12% in 2022. That's this year, year over year, 9% next year, and 6% the year after. By the way, that follows in 2021, 45% increase in operating earnings, profits are strong. For the world economy, after a big decline in 2022, 4.3% and 3.8% growth in 2023. That's strong expansion, punctuated by problems with COVID, but nevertheless, this is a picture of strong economies. Out in the Asian area, we are expecting the Japanese economy to pick up to the 2 to 3% growth range. Inflation in Japan to move higher than 1% and approach its 2% long sought after target. South Korea, a little weaker, but in the 3% range. And China, after having slowed down a lot over the past year, to pick up in growth because of monetary and fiscal stimulus from the latest 4% fourth quarter figure in China to upwards of 5% by the end of this year. What I've described is essentially a pre-pandemic, fully employed economy, growth well above trend, with much, much higher inflation than any time in decades, and a low unemployment rate, a tight labor market. This is a picture radically different from anything in the last 20 years. And it is hard to grapple with for most people. I want to underscore it. It's such a change. Shift time. Every business, investors, and policymakers to get their arms around this. For the Federal Reserve, in what today, U.S. time today, yesterday afternoon, tightening meeting, at least on Chair Powell's question and answer period. His statement was not that hawkish, the statement of the committee, but in it was a clear signal that our central bank, Federal Reserve, is going to, after it stops adding to its balance sheet, start reducing the balance sheet, an $8.8 trillion balance sheet, and reducing it by net selling treasuries, mainly bringing it down. The amount is yet to be determined, but this is a significant tightening of monetary policy. The federal funds rate will remain the key lever for policy, clearly going to rise, unspecified as to how many times, when, the size. That jarred markets today. They want to know exactly what the path is going to be. Chair Powell did not commit one way or the other because the central bank committee hasn't decided, but that leaves a lot of uncertainty around monetary policy and an assumed path of gradual spaced out hikes that would not jar the market. And he really did not give any softness on that. And so the equity market correction, which is a interest rate driven Federal Reserve induced correction, we think percent decline in the S&P 500. That's a significant correction. It doesn't signal that the economy is going to a recession. It's an adjustment to what now is a total change in the interest rate backdrop within which business, investors, analysts have to think. A world of strong growth, of high inflation, higher than targeted, of interest rates on average that will rise for the duration of this business expansion, that will rise. That is the backdrop we are now have entered, and the statement and Q&A of Chair Powell underscored it today. And the equity market, which had been anticipating a hawkish comments and a hawkish move by the Federal Reserve, I think got no solace from his comments, particularly the Q&A. The big problem is inflation that is risen to triple the average 2% target of the Federal Reserve at 6%, and has risen above target in Europe and other parts of the world. And inflation that in our view is a classic demand pull inflation driven by a strong cyclical upturn with very strong monetary policy. But just to summarize what Chair Powell said, quantitative easing will end in early March. That's only 5 weeks away. The Federal Reserve is going to reduce that balance sheet. He didn't say when. We think they'll start doing that late this spring after ending the QE and the tapering ending by early March. The federal funds rate likely will rise soon. He said the pace and size was not clear. Our own forecast is that we'll have a hike in the federal funds rate, 1/4 point in March, 4 more quarter-point hikes this year, 5 total. That's a stronger, more hawkish monetary policy view than I think the markets have had, and we'll see what the central bank says at its March meeting. That would take the federal funds rate to 1 3/8 at the end of this year. Then at the end of next year, up another point. And maybe as high as 4% by the end of next year. Remember, inflation is running 5 to 6% in the United States. We don't expect it to rapidly decelerate. It's high because we have so much demand against supply. It's classic demand pull inflation. We do have supply side tightness, which is adding to it, but the pace and the pattern of how prices have risen, it's a classic demand pull situation, not seen for decades. Well, despite the rises in interest rates, we do think that once we're through the stock market correction, the equity bull market will continue, and that's because of those terrific earnings I told you about. Stock prices depend on earnings, future cash flows and earnings, discounted, and certainly the discount rate against future earnings is going to take down the present value. We won't get the same returns, but the earnings side should drive the stock market so that we think between now and the end of the year, today about 4350 on the S&P 500, we may go down some more. That will be somewhere in the 5,000 range by the end of this year. Rising interest rates, a strong economy doing that, high inflation, but right. Why this forecast? Well, paradoxically, the forecast probably wouldn't be this if we hadn't had the pandemic. Think of the following question. It's a counterfactual question. Suppose the pandemic had never happened. Suppose the world, US and world economy had not shut down totally the way it did in the first and second quarters of 2020. Think what would not have happened if the pandemic had not happened. We would not have had an immediate reduction of interest rates by the Federal Reserve to 0. We would not have had the quick quantitative easing and additions to the balance sheet, purchases of Treasury and mortgage-backed securities that happened almost instantaneously. We would not have had our Federal Reserve directly lending to companies in the private sector. And we would not have had all that fiscal stimulus that came out to support and cushion the economy. What went on in the United States really went on everywhere in the world. Monetary ease and fiscal stimulus. More fiscal stimulus, deficit finance fiscal stimulus, because of the collapse of the world economy thanks to the pandemic. The need for it would not have existed if not for the event. We would not have had the tremendous speed up in the use of technology that we have all been forced to employ, and so many other things as a result of the pandemic and the responses to it. Indeed, science, the 8-month time that it took to develop vaccines, unheard of in history. That's amazing. Technology helps that. So the paradox is that I think we have what I've described in the forecast, as strong as it is in high inflation, because we had the pandemic and all the reactions that came with it. In systems, dynamic systems, that's not unusual. Something happens, there is a response. If there's something didn't happen, there wouldn't be a response. The response interacts in the system, and then the results are different than they would have been if the initiating event had not happened. Well, the assumptions and key elements in the forecast I've described for the US include an assumption that COVID-19 and the Omicron variant will fade. We've had 5 waves of the COVID-19 in the United States, and each time they've had less effect on the economy. We are reopening, business has adjusted. This is true pretty much everywhere in the world. And many more immunizations, many more people vaccinated. One assumption is COVID-19 will fade. Second assumption is the shift from ultra easy monetary policy that I described to tighter monetary policy. Still will leave monetary policy accommodative and supportive. Flows of funds are ample. Rising interest rates alone don't take an economy down. They may slow it some, but they don't take it down. As long as the liquidity and flows of funds are strong in the system, it should do well. And on that, we look at the household sector, 70% of real GDP in the United States economy. Extremely liquid, saved a tremendous amount of money. Household financial conditions, as we measure them, this is proprietary work that we've done for decades, are just about best ever. A high savings rate, lots of funds. This is very different from 2006 and 2007, when the US economy tumbled and all of the sectors inside it were overextended. The business sector, very strong in its spending in the United States, with a lot of liquidity, cash flow far exceeding its outlays, and lots of funds to invest and to expand. And then there is the fiscal side, the fiscal programs, the New Deal-like programs of massive fiscal stimulus of the Biden administration, huge in magnitude. We've had 6 programs of stimulus in the last 2 years. A couple of them were signed while President Trump was still president. The rest have come from the Biden administration. And if you look at the Biden goals, jobs and growth, putting people back to work, number 1. Number 2, using the federal government and its outlays and spending to achieve economic and societal goals for the US economy. And so we had the CARES Act, which was to support the economy when COVID took us out. We had the American Jobs Act. We had an infrastructure program. We have something called Build Back Better, cooking in Washington. The total of the fiscal stimulus is $6.5 trillion over 2 years. That's 25 to 30% of US nominal GDP. You cannot find that much fiscal stimulus in American history, including what we spent in the 1930s as a percent of GDP, and including what we spent on World War II. It's huge. We can't calibrate it, but it certainly is going to be stimulating. The response to the pandemic, and Chair Powell did get this question today, in the desire to keep everybody healthy and the economy running, looks like we overdid the stimulus, the medicine. The intentions were good, but looking at the amount of monetary stimulus and the length of time it's been there, a Federal Reserve behind the curve of inflation and catching up, and all of this fiscal stimulus that has rolled out and will be rolling out. as it is. Well, the underpinnings of the U.S. picture are occurring in a number of places in the world. The working assumptions I made, particularly of the disease, who knows? It's an assumption, and we have to monitor and track that. Inflation is probably the biggest economic risk that is facing the long expansion that we are talking about, because inflation, price inflation, surged on the tremendous demand and macro stimulus. We saw it first in commodity prices, we saw it in oil and energy prices, we now seen increases in wage inflation. The wage inflation and the oil and energy inflation in turn are inputs into price inflation. Companies tend to raise prices to maintain margins. Workers then begin to ask for more money. And the risk here is that the inflation will be too high or get out of control. And then the Federal Reserve would have to raise interest rates a lot more. We might have dislocations in the flows of funds and a recession after a boom. One, geopolitical and political. And geopolitical obviously clashes between the United States potentially and Russia, and clashes between the United States and China. For the Biden administration, the China position has been integrated into foreign policy and economic policy in the context of competition. Competition for the model, the capitalistic model that will win in the long run. China, on most measures, is the second largest economy in the world. China, to me, is a capitalistic, economic, financial capitalistic economy. To a tremendous scholar, Branko Milanovic, he writes, capitalism, we're all capitalists, one degree or another throughout the world. China is a capitalist, but it's a different kind of capitalism than the United States. Ours is a democratic, decentralized kind of capitalism. China's is a centrally directed, autocratic kind of capitalism. And they are, there is a war going on. There is a competitive war. Which model of capitalism will rule the world? Well, it's a question. The jury's out. I am long run concerned about the ability of the United States and its political apparatus to make it work so that the US form of capitalism dominates or coexists. The Chinese capitalism, it's of its economy is, of course, a major threat. And there's always the risk of something worse than competitive economics going on. Negotiations break down. And of course, there is a geopolitical risk having to do with the potential invasion of Ukraine by the Soviet Union and the clash of great countries in a nuclear world where it could get out of control. That's a risk outside of the economy, has impacts on the economy. We watch that. And the final risk I want to mention has to do with the United States and how Washington works. Many of you follow the US situation. Of course, I live here. I've been part of it. I've advised presidents and Congress and senior policy people in Washington for years. Washington it really does not work. It's very clear. And if somehow our country doesn't find a way to make Washington work, and the policies of the Biden administration calibrated correctly and directed to the right places, policies designed to deal with climate change, inequality. Inequality is egregious in the United States. Policies designed to deal with paid family leave, The United States is the only country that doesn't have that. These are embodied in the Build Back Better, the Biden administration, but they were too big. $3 trillion on top of $5.5 trillion. Massive, massive, massive fiscal stimulus. Too much debt, too high deficits. That eventually would take us down. It's not going to be passed this year. We'll see how it goes. And we do have the midterms coming up. We'll see how that goes. The midterms, the Washington scene this year, and the longer run position of the United States in the world, particularly as it relates to China and Russia, those are big risks, not fully outside of economist, analyst, because everything affects economies and markets. And because we're into the markets and policies, we have to watch all of these, including the geopolitics and what goes on in Washington. Let me stop and let's go right to some discussion questions. Would like that a lot.
Okay, thank you very much, Alan, for your very informative presentation, which we appreciate very much. But one thing that I would like to apologize is that due to some technical difficulties, there were cases where we couldn't quite hear and view your otherwise even more excellent opening statement. But certainly Build Back that better that initiative, infrastructure investment facility. It looks like you are in need of that fund to improve your IT communication infrastructure. I suppose. But anyway, you made a lot of points on macroeconomic development and also latest front on financial market development in line with the Fed position. Appreciate that very much. We have two invited discussants, if you like, who will raise question and or comment for you. Now, first, I would like to invite Mr. Oh Young-jin, who is the president of the Korea Times, which is the leading English newspaper here in Korea. Mr. Oh, are you there? I saw you. I saw you picture just before. Can I do that? Okay. Okay. Here we go. All right. Hi, Young-jin, how are you? Okay.
How are you? I'm fine. Thank you so much, Dr. Sainai. It has been
nice to see you. Nice to see you.
Yeah, interesting.
I do see you.
Yeah, lecture. And I have seen you speak on this venue at least 3 times. So I have become quite a fan of your lectures.
Thank you very much. Thank you.
And so at the same time, I felt quite sure that your expertise not just covers the economy in this region. Even if I take you out of your comfort zone and challenge you with not just the economy, but more comprehensive questions, I'm quite sure that your answers would still be relevant.
Well, let's try, but if I don't know, I will.
I have 3 questions, and I want you to answer as much as you can, because I know that sometimes I am the more than handful. So handle as much as you can in the way you see fit. My first question is about Korea, Japan. I often seen Japan is becoming looking inward. I think it's their national tendency, at least in my opinion. And Korea is expanding. Japan is closer to China in terms of hermetic sealing against the COVID-19. The Korea is still coping, but maintaining its openness toward the rest of the world. As the same with a lot of Koreans, I feel more confident about the future of Korea than before. Now, this is my question. Do you think that Korea will surpass Japan as the leader in this region, not just economically, but in other areas as well? That's number one question. May I finish first? Two more questions. So, the answer to the best of your memory. Number two question. Second question is, we have two candidates in presidential elections slated for March 9th. And Lee Jae-myung, progressive standard bearer, he's the candidate for ruling party. One of his major tenet, economic tenet, or the socio-economic tenet, is comprised of the things related to universal basic income. And we know that a lot of the economists are quite pessimistic about the the introduction, or even thinking about the introduction of a universal basic income. I will move this the question of universal basic income not to just Korea, but to the the global level. Do you think that it is about time for the world to think about the more seriously about the the universal basic income? Because we got the AI, we got the the automation, we got the the we are selling at the the prospect that the human beings being made the surpluses rather than the the leader of their own fate. Third question: if Korea has to choose between China and United States as its the greatest the friend and or ally, who would you recommend? Which the country do you recommend Korea should take? Or three questions. If you don't remember the first question, I will jog your memory.
On the very, sure they are. But first question, I would have to say, it depends on the timeline. But I think no, Japan will remain dominant in the Far East. China, of course, dominates it. Japan is next. I think Korea is next. But no, I don't. I just would say no to the first question. What are the reasons? The Japanese economy, the alliances set up, and the size and impact and influence on the world. I certainly would encourage Korea to aspire to be as important and powerful in a competitive economic sense as policies in the Korean country and economy can worth aspiring to. Korea is an incredible country. It is amazing all these years and all these visits when I go there, how well Korea has done with the situation, living with the situation in the North, which is unbelievable from the point of view of a Western observer. On the second question, quickly, that one again.
It's the universal basic income.
Yes. Look, I'm very much a capitalist. I don't think that universal basic income is the way to support those who can't make it in a capitalistic society. I'm a believer in support for the casualties of capitalism, income support, paid family leave, all of that. I'm a believer in changing our tax system to release funds to families. Warren, who's a very left progressive liberal, on a billionaire tax, the way things are now. And I'm not that progressive. But on universal income support, I think the incentives get spoiled, and we don't see the kind of productive effort in an economy and society that you would have without that. But it doesn't have to be all or none. It can be more selective. And then very quickly, the third question, because I understand the last part of that third question, because I didn't hear you well.
But it's about the because there's a lot of talks that the China is emerging a potential alternative as a superpower to United States, and because of the geographic the proximity between Korea and the China, it has been it has been said opening up that the Korea is the leaning toward to China. And I think it's because the China is becoming bigger and stronger, and China wants to want other countries in this region to choose between the China and their traditional ally United States. What is what do you recommend? What is your recommendation?
Yes. That depends on Z. So much of what's going on geopolitically depends on one or two people. And what his ambitions are as lifelong of China. Clearly, Taiwan, Hong Kong has essentially been absorbed and annexed by mainland China. Hong Kong is not anything like the Hong Kong that I knew when I traveled there. And Taiwan is next. I don't think Korea is in the gun sight of China. But there is North Korea and the question of the relationship of China with North Korea. And I don't know enough about Z, other than I see China as a very civilized country wanting a major place in the world, quite impressive in the bureaucratic establishment, in policymaking, amazing to me, and in a country that populous, what can't get done from the center. And so the North Korean head is a renegade in the world. And I just can't believe that a civilized society and government that desires to be the leader of the world, that's China, would tolerate someone who looks psychotic. Just as President Trump looked psychotic to me, so does Kim look psychotic to me. He's a renegade in the world, and North Korea suffers for that. And so I think that's China via North Korea. I don't see why China would have Korea in its sights anytime in our lifetime. It takes a long time to annex Taiwan. Look how long.
Okay. Thank you, Ellen. I think we should move on.
Can I
Mr.
have one, make one point about the Dr. Sainai's, the answer to the last question, because I think, I need, his clarification on this issue, because he's, keep talking about, the Korea becoming, the second or third, the Taiwan. What I meant in my question, it's not the conversion of Korea into, another Taiwan. What I'm saying is, my point is more related to the possible scenario that if China wins, China prevails over Taiwan, and over which, the United States has, the the obligations to defend, then I think it's, there's no room for United States to remain in this region. And that means, perhaps, the Korea would, from the long, the strategic, the point of view, perhaps, Korea should, bring itself closer to China for that eventuality. That's my,
maybe the Biden administration will never not support Korea.
But what about Taiwan?
Taiwan, I'm not sure, but Korea, no. That is too close to the Democrats in terms of the history of the relationship of the two countries. And there is North Korea, which is a threat to the world. The Biden administration would never to China.
Okay, Ellen, I think we should move on. Mr. O, appreciate your three questions, and at least second, third questions are rather controversial. We could talk about these questions for hours from now, but I think we got to move on. But I'm tempted to say just one quick word to the third question. I don't think it's a matter of choose, between United States and China for our strategic purpose, because more and more it has become very clear that the security issues and economic matters are not separable. I think we have to be very faithful to the principles of our great country. That is to aspire free democracy and market economy. Now, we have thrived over the last decades, half century at least, to come to the advanced country rank based upon these values. I think we've got to be very careful about making choice between these two as a great partner. No, I don't think that's a different issue. We got to be very careful, and but of course this is debatable. I appreciate the different views, but for the sake of our limited time, I would like to move on. Thank you very much, and I would now like to invite Mr. Ho Kyung-wook. He's a former ambassador to OECD, and he was also first Vice Minister of Ministry of Finance and Economy, and spent long time at World Bank, IMF, as long distinguished career. Welcome, Mr. Ho, and perhaps toward the end of your comment or question, you may like to say a few words about the last point that was raised by Mr. Ho, if you like. Okay.
Well, thank you very much. Again, it's a very great learning opportunity. I very much enjoyed your comprehensive and insightful view on the most pressing issues. And particularly in this time of market turbulence and great uncertainty, it's comforting to catch on your word about this booming expansion. And I hope your focus turns out right, as it has turned out many times before. I have three questions again. The first question is about this global debt. As you said, a lot of this expansion has been fueled by not only by the technical advances, but also this huge political support, huge policy support. And whenever we see that this big debt increase and the prospect of Fed rate increase, probably steeper than originally expected, then we begin to see that there might be some problem in the emerging market. We already have an emerging market debt crisis. And again, this time again, we have seen it in 2013. I think we have seen the tapering tantrum, but now with the steeper interest rate rise expectation and already huge debt volume, do you see any prospect of a large scale of debt crisis in the emerging market? If you do, where are the most vulnerable parts? The second question is about crypto assets. Not only equities, but also crypto assets has been increasing very fast in the prices, and now it's tumbled down. And many Korean people, particularly young generation, has poured into crypto assets. So my question is, what do you see the prospect of crypto assets in terms of the value, and particularly in view of the expected CBDC issuance from many countries? The third question is about, you have a very interesting view about these two competing capitalistic model between China and the US. And obviously, as Dr. John has pointed out, Korea is following the US capitalist model. And Korea also belongs to the RCEP, which is a huge trade bloc covering China and neighboring countries. Now with this WTO mostly in limbo and with competing this capitalist model, I think that there's a very strong case for the US to come back to the CPTPP. Korea also already applied for the table for the CPTPP. And I just wonder whether do you see the US are gonna come back to the CPTPP anytime soon? And as for this controversial third question that Mr. O has raised, I think it'll take too much time. Let's just stop here for the sake of time.
All right, thank you, Alan.
Right. Yes, the emerging country debt. The U.S. is now in a period of rising interest rates. Normally, that helps the currency. The emerging or developing countries that have a lot of external debt denominated in dollars are at risk in terms of how much they have expanded their budget and how they have financed their budget. So yes, there is a risk as the US raises interest rates, because we think they're going to have to raise interest rates more than most people think. And that means the dollar will get some help. Now, longer run, the US is going to have a debt problem. Longer run. It takes years to develop. We don't have one now because debt serves as a portion of the budget is kind of like nothing. But a 4% 10-year treasury yield in a couple of years and a treasury, 3% treasury, the debt service is going to rise. And then the US still, with the mandatory expenditures that it has, is going to have a constraining debt problem. And it will then have a dollar problem. But for the near to intermediate term, yes, I think there are some emerging developing countries. I'd have to look at them to see what the composition of that external debt was. You probably know this better than I do. But dollar denominated debt, I would not want to invest in an emerging developing country that has a lot of dollar denominated debt at this point. I missed what you said in the second question a little bit there.
Second question is about the crypto assets. No, Bitcoin, Ethereum, and all those stuff.
The digital currencies.
Right.
Yeah. Well, the digital currencies are, to me, speculative. I think years we may have no cash. It's all going to be digitized. But there's so many competitors for that as an investor, an investment advisor in the markets, I stay out of those markets. They're just too speculative. So the obvious major theme is, look on electronic vehicles. I am saying such things as, in 5 years, I may have the only internal combustion engine in the United States. I have an Eclipse, Mitsubishi Eclipse 2004, and I'm hoping when it's an antique, it'll be worth a lot more money. But it's internal combustion. There's a tremendous rush to EV and EV stuff, and once that gets going, and it's economically and product advantageous, everything will be digitized. The speed of the technology of the change is unbelievable, but I can't pick out any one of those digital currencies to put money on. It's just too speculative. And then the last was, or did I answer all?
This CPTPP, when you have seen the Chinese bloc and the US bloc competing?
So. I don't know, but I hope so. I think the Biden administration is international. He is more likely in the administration, people he's chosen, to look for to restore alliances than to go the other way. There is so much on their plate right now. Look at all the stuff that's going on. And at least in some of the surveys and polls, this poor aged man, I sympathize with him because I'm a little older than he is. I think he's doing okay. And it will count. We'll see what life is like come this August, September. I think the economy is it's going to be very good. People have a lot of money in their hands. COVID will be pretty much gone. Yeah, so they may forget about the problems he's had so far, but he's got his hands full. And I think this is just not on the top of their agenda at this point. Mm-hmm. I hope we go back to that. That would be my advice. I haven't been asked.
Okay. Is that okay with you, Mr. Hull?
Yeah.
Okay, thank you very much. Now we have only about 5 minutes left, so perhaps I may pursue some questions reflecting on some feedback from our viewers through chatting room. Perhaps just a couple of questions. One has to do with the macro forecasting that you have shared with us today. Compared to IMF, World Bank, OECD, like multilateral organizations, and also investment banks, recent forecasting for this year and beyond, your prediction, your forecasting appears to be a bit more optimistic, which I appreciate.
Yes.
We need
Yes.
some optimism.
No, but that's right. And it was a year ago, and
right.
we picked up that the upturn before almost anybody back
You're
in
right.
April 2020.
Yeah,
You know, it's a business cycle. It's a business cycle. It looks very classic. The amount of stimulus is so huge, and the position of the household sector and business sector, the liquidity, so much stored up purchasing power, pent up demands. I've seen it before, and it's just powerful. My concern is it's going to be too much, and we'll get too much inflation, and then the Fed will have to stamp it out. Look at the labor market. We're at 3.9% unemployment rate. Our forecast for a week from Fridays will be at 3.8. It's an extremely tight labor market. Everywhere you go in the United States, you see people out having, despite the illness. It's something. It's a boom. I say booming expansion. I hate to call it a boom because booms are part of the business cycle, and they end sooner when you have a boom because excesses develop. But no, it's just so strong, and almost every way we look at it, the data inside the financial position of the aggregate household sector, 70% of U.S. consumption, cash flow in excess of CapEx by business, so much cash to spend, the amount of entrepreneurial new businesses that are being restaurants, our surveys show tremendous pessimism. But, you know, I think it's about Washington. The country has gone through so much divisiveness, all the incidents last year, all the Trump chaos, which is still not gone. So our country is in chaotic, but I think the lack of confidence is in Washington. But the economy will win if it stays strong, the unemployment stays low, and the confidence of Americans 6 months from now, I think is going to be a lot higher. Now, it's science, it's models, it's a business sector, but there's a little judgment in there. And the judgment is on the technology side. I have never seen such productive technological change go on at any time when we've had technological change in the US, and it's worldwide. It's worldwide. It's in Korea, it's everywhere. It's extraordinary.
Thank you for your outlining the basis for your relatively optimistic forecasting, especially for the United States. That's well done. The question actually I had was more about China. Somehow our discussions also raised a question relating to China. But there, my reading of most other forecasting I have read lately, much more cautious or some pessimistic about at least the short-term performance, expected performance of China because of the ongoing issues relating to high debt issues, Evergrande problems, and so forth. And also more structurally, many point to the weakening productivity and this productive labor force, declining productive labor force because of demographic changes over there and some other structural impediments. Now, what are you? What sort of what is driving your
Right.
relatively
Those are all
sanguine
valid.
perspective
Yeah,
of China?
There are huge problems. The financial fragility of China is huge. Real estate problems are huge. The slowdown in growth is very recent. China came out of the collapse faster and sooner than anybody. Was very strong. So their growth rate last year for the whole year was 4.7%. It dropped down in the fourth quarter. There is plenty of room for the center to ease monetary policy and spend money. And those are strings that are pulled from the very center and happen very quickly. So the control over the macro policy apparatus, I think, is huge. And from the point of view of Xi, he can't let the economy be weak too long. So we are thinking we will see much more monetary ease, fiscal policy, and the clamping down on the excesses like Evergrande that they did. I think the competitive spirit, the entrepreneurial spirit of China is being hurt. It's very interesting to see, and I use the phrase, Xi is killing capitalism. He's gone after the rich people to help out the common person in China, a worthy goal, which is to reduce inequality. I wish we could do more of that in the United States, but the way in which he did it kind of kills the capitalistic entrepreneurial spirit of China and money going into China. And that, I think, was a huge blunder to do it that way. Who can deal with the psychology of the heads of states that we see around the world that get elected or come to power? Xi, Putin, Donald Trump, Joe Biden. Joe Biden, I think, is easy to read. He's an ordinary American with an interesting, ordinary background. It's about time we had somebody like that. But you know what? He's running into lots of problems in Washington. It's very difficult.
Okay. Well, perhaps a very last question before we let you go. That is that about, this is more micro compared to the big picture. Now, you talked about investment prospect, market prospect. You still believe bullish condition or sentiment will prevail despite the recent turmoils. Now, could you say something about relative performance of different industrial sectors? Now, of course, in this changing rate environment, of course, some sectors would benefit more compared to others. Now, if you say financial or wherever, maybe in a better position, or some consumer spending related manufacturers maybe in a position.
No, hands down.
To,
yeah, hands down. In the United States, the sector is healthcare for a lot of reasons: aging population, technology, emphasis on that. But for the world, it would be the consumer. Look what the world's been through. Look at the number for the world economy, down over 3%, 2020, US minus 2.3%. Country after country went down. People couldn't spend, they couldn't go anywhere, they couldn't do anything. That will power the world expansion. So consumer-related sectors, discretionary consumer staples, I think I would definitely favor those sectors. Technology, it's awesome. Technological change that goes on, but we don't put it at the top of the heap anymore, because when interest rates are high, you just, as an investor, you can't buy those high PE companies, and it gets harder for them to easily finance it. There's a little bit of a bubble in that. And finance is the infrastructure of so many economies, so banking should do well. But it's the consumer, hands down, for the world, since your question was, I think, a global question.
Okay, excellent. Thank you very much. I think this is the time to close. I appreciate your excellent presentation and the stimulating discussion for this hour. Despite some technical difficulties, we got the gist of your important points. And I very much look forward to seeing you again, perhaps in person next time. So till
We
then,
said that last year, but I think next year it will be possible.
okay,
It may be possible.
very much look forward to it.
Thank you very much for inviting me.
Okay,
It's a delight
stay
to talk
safe
to you.
and healthy till then.
Thank you.
Thank you very much.
All the best.
I would like to thank our audience as well. Thank you very much.
Bye-bye.